Welcome back to the deep dive. Our mission today, well, it's maybe a bit unusual. We're taking sources on personal wealth, global risk, and some pretty detailed accounting standards.
IFRS 9 specifically.
Exactly.
Yeah.
And we want to show you how they're all connected. We're going deep into how you manage your earning risk and how big companies handle things like interest rate risk using, well, this advanced stuff called hedge accounting.
Yeah, and I think the core theme here is really alignment. The goal is to see how these rules, like IFRS 9, aren't just for bookkeeping. They're actually built to make the financial reports truly reflect what the company is doing economically to manage risk, volatility.
So we're tracing that idea from something really personal, like your own total wealth, all the way up to corporate financial statements.
That's the plan.
Okay, so let's start broad. Risk management 101. When you're facing uncertainty,
Yeah.
could be anything, crossing the street, investing, you've basically got four choices, right?
That's the standard framework.
Yeah.
You can avoid the risk altogether.
Like, don't invest, don't cross the street.
Right. Or you accept it. Just live with the potential consequences. Then there's Jizun. Reduce it, maybe wear a helmet, or diversify investments.
And the last one, transfer it.
Yeah, transfer. And that's huge because it's the basis for, well, insurance, derivatives, the whole industry, really. You pay someone else to take the risk.
Buying insurance is the classic example, or maybe a forward contract to lock in a price.
Exactly. You're transferring that price uncertainty.
What's really interesting from the material, though, is how bad our intuition can be about risk.
Oh, definitely.
Yeah.
We looked at some stats comparing activities to driving, using driving as like a baseline of 1x risk.
And you'd think something like skydiving is incredibly risky.
But the data says, was it 33 times safer than driving, based on fatalities per event. So like not a 0.03x relative risk.
Yeah.
It's kind of mind-blowing.
And scuba diving, even safer on some measures.
It really highlights that managing risk effectively, whether it's your life or company's finances, has to be based on, facts and data, not just gut feelings.
Okay, so translating that general idea of uncertainty to corporate finance, it gets specific. You mentioned IFRS standards don't actually define risk with a capital R.
No, not in a single definition. But IFRS 7, that's the disclosure standard, it does require companies to talk about uncertainty. Specifically, uncertainty around the amount, timing, or certainty of future cash flows.
And those uncertainties fall into specific buckets.
Yeah, the main financial risks companies disclose are generally three types. First, credit risk. That's basically the risk your customers or counterparties won't pay you back.
Makes sense.
Then liquidity risk. Can the company meet its short-term bills? Does it have enough cash or access to funds? Very important.
Okay, and the third?
Market risk. And this is key for our discussion today. It's about volatility for market movements, specifically changes in interest rates and foreign exchange rates. That interest rate piece is what really drives the need for hedging with things like swaps.
All right, let's shift gears. From the big corporation worrying about interest rates, down to you, the listener. We're talking about something called CFA human capital theory. And the takeaway message here is, apparently, you are richer than you think.
Yeah. It's a nice thought, isn't it?
Okay.
But there's solid theory behind it. Your total wealth isn't just your bank balance or your stocks.
Right. It's an equation. Total wealth, financial capital, plus human capital.
Exactly. Financial capital is what you've already saved, your assets right now. But human capital, that's the big one, especially early on. It's the present value of all the income you expect to earn from working in the future.
So discounting all your future paychecks back to today's value, your earning potential.
Precisely. Your capacity to earn, save, and build that financial capital over your whole career.
And that balance shifts dramatically over a lifetime, doesn't it?
It absolutely does. The sources show this curve.
Yeah.
When you're, say, 25, your human capital is enormous. It dominates your total wealth. You might not have much saved yet, but you have decades of earning potential.
All that future income potential.
Right. But as you get older, say towards retirement, your remaining human capital shrinks, fewer working years left, while hopefully your financial capital, the money you've actually saved and invested, has grown significantly.
So they sort of swap places in terms of importance to your total wealth.
They do. And that curve tells you exactly where your biggest risk lies at different stages. When you're young, the catastrophic risk isn't losing your small savings pot. It's losing your ability to earn that huge future income stream.
Ah, so that's why things like disability insurance and life insurance are so critical early on.
Exactly. Those are your personal hedges. They're like derivatives for your human capital. You're transferring the risk of losing that future earning power.
That's a really neat way to think about it. And you mentioned connecting this to finance terms, clean and dirty pricing. How does that fit?
Okay, yeah, this is a good analogy. In bond or swap trading, the clean price is just the present value of the future cash flows, ignoring any interest that's built up but hasn't been paid yet.
So the clean price is like your human capital, the PV of future income.
You got it. It aligns perfectly. And the accrued interest is the interest earned but not yet received. It's like the cash or assets you have right now.
Which is our financial capital.
Exactly. So clean price plus accrued interest gives you the dirty price, the all-in price you'd actually pay.
Clean price, human capital, plus
Right.
accrued interest, financial capital equals dirty price, total wealth.
Precisely. It shows the underlying components are similar, whether you're valuing yourself or a complex financial instrument. Future potential plus accumulated value.
Okay, now we make the leap. You hedge your personal income stream with insurance. Big companies hedge financial risks, like changing interest rates on massive loans, using derivatives, things like interest rate swaps or IRS.
Hmm.
And this brings us squarely into IFRS 9 and hedge accounting. What's the core problem it's trying to solve?
Well, the big challenge is a timing mismatch in traditional accounting. Derivatives are usually mark-to-market, meaning their value changes hit your income statement, your P&L, every single quarter, instantly. But the thing you're hedging, say, the future interest payments on a loan, those costs only hit your P&L over maybe the next 5 or 10 years as you actually pay them.
Ah, so the derivative value swings wildly now, but the underlying cost it's protecting unfolds slowly, creates noise.
Exactly. It creates volatility in your reported earnings that doesn't reflect the actual economic reality of your risk management strategy. Your strategy is reducing volatility, but the accounting makes it look more volatile. IFRS 9 hedge accounting is designed specifically to fix that mismatch.
So it's about making the accounting reflect the risk strategy, not just record numbers separately. How does IFRS 9 categorize these hedges?
It basically puts them into three main types, depending on what risk you're hedging. The two most common are probably fair value hedges and cash flow hedges.
Okay, that's the difference.
A fair value hedge is used when you're worried about changes in the value of an existing asset or liability on your balance sheet. Think hedging a fixed rate loan against changes in its market value if rates move.
Got it. And cash flow hedge.
That's more common for what we're discussing with interest rate swaps. It's used when you're hedging the variability in future cash flows. Like you have a floating rate loan and you want to lock in your future interest payments. You use a swap to do that, and that's a cash flow hedge. Protects against unpredictable future payments.
So if a company swaps its floating rate debt to a fixed rate using an IRS, that's typically a cash flow hedge. But just doing the swap isn't enough for the special accounting, right? It has to work.
Right. It needs to qualify for hedge accounting. And IFRS 9 lays out criteria for that. It's not just a label you slap on. The relationship has to be genuinely effective from the start.
What are the main tests?
There are three key conditions. First, there has to be a clear economic relationship. The hedge instrument, the swap, and the hedged item, the loan payments, need to move in opposite directions predictably. They have to offset each other economically.
Makes sense. If they don't offset, it's not hedging.
Second, credit risk can't dominate the value changes, meaning the main reason the swap's value is changing shouldn't be because you're suddenly worried the bank on the other side is going bankrupt. It has to be driven by the market factor you're hedging, like interest rates.
Okay.
And the third, the hedge ratio has to match the company's actual risk management strategy. If you have a $100 million loan, but you only hedge $50 million with a swap, the accounting has to reflect that 50% ratio.
Yeah.
You can't just apply hedge accounting to the whole loan. It ensures the accounting follows the actual management intent.
All right, so let's say the hedge qualifies, it's effective, the ratio is right. Now we have to figure out what these derivatives are worth. They need to be valued at the end of every reporting period.
That's right. They're carried on the balance sheet at fair value.
And how does IFRS define fair value? Is it complicated?
The definition itself is actually quite simple conceptually. IFRS 13 defines it as the exit price. Basically, what price would you get if you sold the asset, or what would you have to pay to transfer the liability in an orderly transaction between market participants right now at the measurement date?
So it's market-based what it's worth today?
Yes, very much market-based.
Yeah.
Not what you paid for it or what you think it should be worth, but what the market indicates it's worth now.
But swaps don't trade on an exchange like stocks. How do companies figure out that market price? There's a hierarchy, right?
Exactly. Since you often can't just look up a price on Bloomberg, IFRS 13 sets out a fair value hierarchy based on the inputs used in the valuation. It has 3 levels.
Level 1.
That's the best, the most reliable. Unadjusted quoted prices in active markets for identical assets or liabilities. Think stocks on the NYSE.
Okay. Swaps aren't usually level 1, then.
Generally not.
Yeah.
They typically fall into level 2. Level 2 inputs are observable inputs other than those level 1 quoted prices. For an interest rate swap, this would be things like observable yield curves, interest rate data from the market, maybe credit spreads, data you can see, but you need a model to put it together into a value.
So based on market data, but requires some calculation, what's level 3?
Level 3 is based on unobservable inputs. This is where the company has to use its own models and assumptions about what market participants would use, because there isn't direct observable data. It involves more judgment.
Gotcha. So swaps are often level 2 using observable market rates in a model. Okay, so we have the fair value. Let's link back to clean versus dirty pricing for the swap itself.
Right. So just like with the human capital analogy, the clean price of the swap is its fair value, the present value of its expected future net cash flows, calculated using those level 2 inputs usually.
That's the number that goes on the balance sheet as the derivative asset or liability.
Yes. And the dirty price includes that clean price plus any accrued interest on the swap.
Ah, the accrued interest again. And that part, the interest that's built up day by day based on the swap terms, like the difference between the fixed and floating leg, that hits the P&L directly, right? Regardless of hedge accounting.
Correct. That daily accrual just flows through your net finance costs in the income statement. It's the operational part of the swap settling up. Hedge accounting under IFRS 9 primarily deals with the change in the clean price, the fair value change.
And this is where the magic happens to avoid that P&L volatility we talked about. Where does that fair value change go, if not the P&L?
For an effective cash flow hedge, the change in the fair value, the effective portion of it, bypasses the P&L initially. It goes into something called OCI.
Other comprehensive income, which is part of equity, like a temporary holding area on the balance sheet.
Exactly. Think of it as a reserve account within equity. So on your balance sheet, you'll see the derivative asset or liability at fair value, and then an offsetting amount building up in this OCI equity reserve. The P&L is shielded for now.
Okay, shielded. But the gain or loss is real. It has to eventually hit the P&L, right? How does that happen?
It does. This is the crucial step, often called OCI recycling or reclassification. When the hedged item, the thing you were protecting, like the future interest payment, actually affects the P&L, you then recycle the corresponding gain or loss sitting in OCI out of equity and into the P&L in the same period.
Ah. So if you hedged an interest payment for this quarter, when that interest expense hits the P&L, you pull the related gain or loss on the swap out of OCI and match it against that interest expense.
Precisely. The result is that the net interest expense reported in your P&L reflects the hedged outcome, the rate you effectively locked in. It perfectly aligns the timing of the hedge result with the timing of the underlying hedged cost. That's the whole point.
It smooths the P&L and reflects the economic strategy. What if part of the swap's value change wasn't effective? Maybe the hedge wasn't perfect.
Any ineffective portion, the bit of the swap's value change that didn't offset the change in the hedged item properly, that doesn't go to OCI, that hits the P&L immediately, usually in other gains or losses. Because it didn't work as a hedge, it's treated more like speculation.
Wow, okay. That brings it all together. We started with, basic risk choices, thought about your lifetime earning power as human capital,
Hedged with insurance.
and ended up deep in the plumbing of corporate finance, using OCI recycling to make derivative accounting match economic reality for interest rate swaps. The constant theme seems to be this desire to smooth things out, to manage uncertainty.
It really is universal. Whether it's you transferring the risk of losing your human capital via an insurance policy, or a huge company transferring interest rate risk using a complex derivative that qualifies under IFRS 9, it's all about managing exposure.
Which leads us perfectly into the final thought for you, our listeners, to maybe ponder.
Yeah, so think about this. We established that a typical corporate hedge, like an interest rate swap, its fair value is largely based on level 2 inputs, observable market data like yield curves. Relatively objective.
Okay.
But your human capital sends the present value of your future expected earnings. What goes into calculating that? It relies on assumptions about your future salary growth, inflation, how long you'll work, the right discount rate, lots of estimates about the future.
Things that aren't directly observable in the market today.
Exactly. So if we map that back to the fair value hierarchy, does valuing your own personal wealth, specifically your human capital component, accurately rely much more heavily on unobservable inputs, level 3 assumptions, than valuing a multi-million-dollar corporate derivative? What assumptions are you making about your own future income stream? And, well, how confident are you in those inputs?
Something to definitely think about.
Indeed. Thanks for joining us for the deep dive.